This line shows that the 16-year-long bull run that effectively began in 2009 could very well tip into an era of negative growth in real terms. The important thing about this chart is that it is not showing the regular S&P 500, but the S&P 500 in real terms, meaning adjusted for inflation. And that changes the whole story. In nominal terms, the index looks like a long upward machine because dollars lose value over time. But in real terms, the market becomes far more cyclical. You can clearly see long bull markets followed by long periods of stagnation or decline. The post-war bull market, the inflation-adjusted bear market of the 1970s, the huge 1982 to 2000 bull market, the lost decade from 2000 to 2009, and then the current bull market that effectively began after the financial crisis in 2009. It goes bull, bear, and that is the key risk today. This current real bull market is already around 16 years old, which puts it deep into the historical zone where it's important to stop thinking the trend is permanent. It means the market may eventually take a different course, not necessarily one sudden collapse, but possibly years of weak or negative returns after inflation. That is why this chart is so powerful. The nominal S&P 500 tells us the price, but the real S&P 500 tells us more of the real value. Stocks in real purchasing power terms move in cycles, and after long periods of secular bull market, there has usually been a similar period of secular bear market. Right now in 2026, there are plenty of economic and geopolitical risks and signs of pressure underneath the surface. And yet the stock market is booming, with the S&P 500 sitting around 7,500 points. Over time, stock prices should ultimately follow the earnings of the companies inside the index, because valuation is really a relationship between what investors are paying and what companies are earning. If stock prices rise aggressively while corporate profits remain flat, then the market is not being driven by stronger fundamentals, but rather driven by investors paying more for the same earnings. That can happen for a while, especially when optimism is irrational. But the gap cannot expand forever. This chart shows the difference between the 5-year cap and the fair value model. This valuation model is based on what actually should be included as ingredients necessary for a healthy growth. Yes, the market is expensive. Yes, the S&P 500 has moved a lot. But valuation is not just price. Valuation is how much investors are willing to pay for earnings, and that willingness depends on whether margins are strong, earnings are growing, and credit spreads are calm. What this chart shows is that today's market, while elevated, is still much more connected to fundamentals than the market was in 2000. Back then, prices ran far above what earnings and business reality could justify. Today, higher prices are at least partly supported by stronger margins, better earnings, and a credit market that is not directly screaming a crisis. We did show in the beginning of this video the difference between real S&P 500 and non-adjusted S&P 500. A stock index is quoted in dollars, but dollars themselves lose purchasing power over time. So when the S&P 500 rises, part of that rise may reflect real business growth, but part of it may simply reflect the fact that the dollar is worth less. A weaker dollar makes asset prices look higher in nominal terms, and this chart perfectly shows that during periods of high inflation, the dollar devaluates faster. Periods of high inflation during the 1970s and the recent one in 2021 ultimately lead to the purchasing power of the dollar to decline. For the market to keep rising in a healthy way, profits need to catch up. Otherwise, what looks like strength in the index may partly be an illusion created by inflation. And this is an important chart. Margin debt is basically borrowed money investors use to buy securities. In this chart, we're showing the margin debt as percentage of the M2 money supply, or in other words, the amount of liquid money in the US economy. So when we look at margin debt as a percentage of M2, we're really asking how large is speculative borrowing compared with the liquid money sitting in the system. It's the measure of leverage. Raw margin debt will naturally rise over decades because markets, GDP, and the money supply all grow. But margin debt relative to M2 gives you a cleaner feeling for whether leverage is becoming excessive compared with the liquidity base. And right now this ratio is telling us that leverage is back in a danger zone. The previous peaks of this ratio, of this curve, clearly show the dot-com bubble, the 2007 global financial crisis, and COVID period. Now again, beginning around 2025 and still continuing climbing, the ratio is back at almost 6% of the M2. That means investors are using a historically large amount of borrowed money relative to the money supply. Obviously, this ratio doesn't predict when the market will turn over, but it tells us how flammable the market has become. When leverage is high, the correction can turn violent because selling creates more selling. None of the information provided should be considered financial advice or investment recommendation. Our goal is serving you the best educational content. Thanks for watching. This is Glinius.